Welcome, friends. In today's session on the paper Advanced Financial Management CA final level, I CA Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now, as we are continuing this series, it is a hybrid mode where I hope you must have gone through the lectures. Now, today our faculty CA Divas Gupta sir will briefly revise the topics that has been covered, and also he will discuss some questions with you also. Student, you are free to ask any questions during the session as well as after the session. So, without taking much of your time, now I hand over the show to the CA Divas Gupta sir. Divas sir, welcome. We welcome you
Thank
to
you.
the session. Now
Thank
it's
you.
up to you.
Sure.
It's your show. Okay, thank you.
Thanks a lot, sir, for the opening remarks. Now we will take up the revisionary aspects on the derivatives chapter.
Okay.
So students, you would have gone through the recorded lectures on the derivatives. So today we will just first discuss the flow of the derivatives entirely. We will see what are the different types of derivatives, what are some of their the pricing valuation methods that we use, and then eventually we will come to know some of the new things in derivatives. For example, the weather derivatives, electricity derivatives, commodity derivatives, and yes. So let's start with the brief, understanding of derivatives. What does a derivative means? So students, we started our discussion saying that let's assume there are two different parts. One, for example, one which is A, which is called as a financial instrument, and B is called as an underlying. Now, A, which is a financial instrument, it derives its values from B. It is not having its own value. It is dependent on B for deriving its value. So that is why it is called as derivative, because A is deriving its value from B, students. Now, what is B? B can be anything that we discussed four broad things in our topic. One was equity. So equity of anything called X Limited, Y Limited, any company, right? That can be an underlying. Then one sort of a index. What are index, students? Index we understood were some kind of a market. For example, Bombay Stock Exchange, National Stock Exchange, these are the markets, right? And even then, so these are the market for the entire economy. For a specific industry also, there can be markets. Correct? For example, FMCG index, that will represent the index of all the FMCG companies, right? Similarly, other things. So index is something which is related to a market. So even a market index can become an underlying. You would have understood, you would have heard of Nifty futures, right? So those Nifty futures are nothing but the derivatives trading on the Nifty as an index, wherein the underlying is Nifty as an index. Then third types of the underlying is foreign exchange. Now, foreign exchange, we all know any currency other than INR, euro, pound, or dollars. If we enter into a derivative which derives its value from the movements of these currencies, that is called as a foreign exchange derivative, which has an underlying as foreign exchange in it. Okay. Then fourth part is commodity derivative. Sorry, commodity as an underlying. For example, crude oil, sugar, or metal that we have understood here is something if taken as an underlying, and any derivative operating on that underlying, that is called as commodity being underlying for that derivative, right? And hence this A part, which is the financial instrument. Just a second. Yes. So this A part, which is the financial instrument, is called as a derivative, and B is referred to as an underlying. Okay. We also discussed here what is actually Nifty. In Nifty, we have top 50 companies by market capitalization. Their movement is actually tracked to see what is the index coming out to be, right? So let's say in 2011, if that was 1000 and 2024, now it is 5000, right? So this has become five times. The price has become five times of all the companies that are there in that index, students. Okay. Yes. So the fifth type of underlying that we also discussed was weather. Sometimes what happens, your your actual, let's say, business is also dependent on weather, how weather turns out to be. For example, your production might be dependent on weather, or the consumption of a product to the consumers might be dependent on weather, right? So, for example, in rainfalls, higher amount of umbrellas and other water preventing measures will be useful, right? Similarly, higher amount of rainfall would be needed for certain types of crops to have a higher production. So, any changes to the weather might bring upon a change to the business, and hence we can link it to the commercial changes. So that's why any derivative which has a underlying, any derivative can also has an underlying as weather, right? Because weather changes is linking your business to some kind of a profit or loss. Correct. We will discuss the weather as an underlying for a derivative in detail. These are called as weather derivative, students. Okay. Now wait, there is a question from, I think, Abrikesh. Top 50/30 remains stagnant or changes? No, it changes. Abrikesh, it changes basis the basis the revised market capitalization. Okay. It is not stagnant. Now, derivative, students, financial instruments are such contracts. Okay, first of all, we need to understand there are some standard terms of these derivatives. Whether we talk about any type of derivative, these have some common features. What are they? There is a buyer and a seller. For any derivative, there has to be a buyer and there has to be a seller. So someone need to sell and someone need to buy. For example, buyer and seller. Buyer will buy A. A was what? A was our financial instrument, which was derivative in the previous sheet, right? And seller will sell A. That is understood. Now, A, which is a derivative, Mr. A can be a buyer and Miss B can be a seller. However, if we talk about the underlying, which was B in our example, it is not necessary that Mr. A and Miss B will still be the same parties for underlying also. No, it will be different. Mr. C and Miss D can be buyer and seller for the B, which is underlying. So the point that we are trying to make here is that, students, that there are two different market, students. One is the derivative market in which A is getting traded, and second one is the underlying market where B is getting traded. And hence the buyer and seller of derivative will very much be different with the buyer and seller of the underlying, students. Clear till now? Correct? Yes, always, Abrikesh. They will be considered, yes. Political factors are also considered, Abrikesh. See, there are a lot many things that can be considered, right? However, we are restricting our discussion to certain, let's say, useful topics that we will be using, that we can use in our practical life later on, okay? And give us a better understanding. So, A part, which is the derivative market, is also called as FNO market in the If you see any let's say stock exchange, in that there is a separate segment called futures and option segment, that is called as FNO segment, right? And this is called as a cash or spot market, where the spot equity share is dealt with, right? So students, if you see, this is a derivative. It is deriving its value from equity in a way, right? Because in this example, we have taken equity, and equity is deriving its value from the business, students, right? What is the underlying business that we have discussed, I think, in the portfolio, right? Then value of a derivative is depend. So this was the first feature. Okay. The first feature is what? There is a buyer and there is a seller. Okay. Of a derivative. The second feature is value of a derivative is dependent on the value of its underlying. That is the first concept that we started with. You talk about any derivative, students, always the value will depend on the value of its underlying. Then only it will become a derivative. Okay. And then this is the second point, is also pretty easy. Third point, students, there is a fixed tenure of such derivative. Now, students, please understand, this derivative is what? In physical form, does it imply something? No, it's not there in physical form, but it's there in the contractual form. Okay. It's there in the contractual form with some of the terms and conditions written in them. Now, if it is a contract, the contract has to have a fixed tenure. Correct? So that's why we are saying that there is a fixed tenure of this derivative. And for all derivatives that we have in our syllabus, we understand that it can be for 1 month, 2 month, 3 month, 2 years, 4 years, but it will have a fixed tenure. Okay. Whatever that fixed tenure we want to make it, we will make it. But there is a fixed tenure. It is not open-ended. Then fourth part, students, is the settlement. The fourth important feature is actually the settlement of such derivative. Now, settlement is what, students? Settlement can happen as a payoff from buyer to seller. Either buyer will have to pay to the seller or seller will have to pay to the buyer. That we will see how we have to derive that in our today's discussion, that we will understand how to calculate a payoff. Okay. But as of now, we understand that since settlement has to happen towards the end of that tenure, the settlement will happen through payoffs. Now, students, if you see, there are some things that are certain or fixed in nature, and there are other things which are uncertain or variable in nature. Now, first of all, students, what is certain or what is very specific? One is underlying. What is my underlying? Second is the quality of that underlying. Then third is even the quantity of that underlying. And last one is the time period. So these are all things are very specific or very certain for the derivatives to operate. Because if I don't specify the quality or the quantity of the underlying, specifically in case of a commodity derivative, where we have different types of quality, where we have different quantity is true for all, then in that case, our contract is not very specific, right? And we might end up having difference of opinion between the buyer and seller. To avoid that, it is specifically mentioned. Similarly, uncertain is what? Price of the derivative, because it is derived from the underlying. So basic features are clear, students. One is there are two parties, buyer and seller. Second is it is dependent on the value of a derivative is dependent on the value of the underlying. Third is fixed tenure of the derivative because it's a contract. And fourth is the settlement part. Okay, students. I hope the overview of the derivatives as a concept is clear. Then we will move to the specific types of derivative, students. First one, students, is the forward contract. So we have studied about in your recorded lectures you would have seen about the three broad types. One is the forward, second is the future, and third one is the options. Right? So we'll start our discussion with the forward contracts. For forward contract students, we took an example of a procurement manager students. We said that this procurement manager wants to purchase a crude oil which is grade A, 20 liters, but delivery after 6 months from today. And today's price is rupees 100. After 6 months, the prices are likely to go up. So procurement manager is finding out a supplier, sorry, who is willing to lock this price, right? And supply after 6 months. Now, both of them have come to a table and a conclusion, hence, that the 110 per liter will be the right price at which procurement manager will buy it from the supplier after 6 months from now. Okay. Now, this is kind of a forward contract. Reason being, the delivery is going to happen after 6 months. So it has a tenure of 6 months. There is a buyer and there is a seller. Okay. Then third part is the value of this contract will actually depend on the crude price, which crude oil, which is the underlying. Correct. And ultimately at last, the settlement will happen. The settlement will happen through payoffs. Now payoffs, now sorry, the settlement can happen in two ways, students. One is that this procurement manager will say, okay, you give me the delivery, I will pay you in cash, the 100% amount. By cash, I mean through the bank transfer. Okay. However, the second part is, and this is sorry, the first part is called as gross to gross. Gross, you give me the delivery, gross, I pay you the amount. The second part is the net basis, students, wherein the amount will be either paid by procurement manager to supplier or supplier will pay to the procurement manager. Those are called as net settlements. So, whichever way the terms are defined in a forward, accordingly, the treatment will be done on the settlement. Okay. Mostly forwards are based on the deliveries, wherein the gross delivery is taken and the gross payment is made. Okay. Now, these are the terms at 110. Now, what will happen after 6 months, students? After 6 months, we have taken three cases, case 1, 2, and 3. The actual price, we have taken all the three cases. One, it is higher, lower, and similar. So the actual price comes out to be 115. In such a case, what will procurement manager say? I have an agreement with you to supply to me at 110. So I have a 5 rupees gain because if I have gone to the open market, I would have paid 115, for which I am now only paying 110. So there is a 5 rupees gain to the procurement manager because this is the negotiated price. And to the supplier of that crude oil, there is a 5 rupees loss. So Abrikesh is saying, can we say that derivatives are a function of underlying? We can say that the value of the derivatives are a function of the value of the underlying Abrikesh. Okay. Because it's all about the value in a derivative. Then second part, students, 95 is the actual price. What is the negotiated price? 110. Now see, what will procurement manager think? Procurement manager will say that in the open market, he would have got it at 95 rupees. That is 15 rupees cheaper than the negotiated price. So don't you think that this procurement manager has incurred a loss because he has entered into this contract, and as per the contract, he has to settle it at the 110 rupees, students. Okay, so there is a 15 rupees loss here. And if it is a loss of the buying person, it will be a gain to the selling person, because now think it from the seller perspective, students. So seller will say that I have to sell at 110. The item in the open market is being purchased and sold at 95. So I'm able to sell and realize more by 15 rupees. So there's a 15 rupees gain to me because of this contract. Okay. So students, please understand this will form our base for the entire discussion later on. Okay. So please, I hope you understand how to think it and how to assess whether the buyer is in a loss or whether the seller is in a loss, right? Depending on what position they have taken, depending on what prices are actually being there and what is their contracted price. Okay. Then third part, the price remains 110. So then no loss, no gain situation for any of them. Okay. Now let's talk about the settlement. So these were what? These are, you can say, the gain or loss after 6 months. In a way, this is a settlement gain slash loss. Okay. During the settlement, what is the gain or loss? Now, settlement of a forward contract, students. After 6 months, what will happen? Procurement manager will pay to the supplier 20 liters into 110 as 2200 rupees, and supplier will deliver 20 liters of crude oil grade A. Students, if you see quantity, grade A is quality, right? And crude oil is your underlying. So all these things are specified in the forward contract. Then only it will be more objective. Otherwise, we will never. Otherwise, there will be differences of opinion between both these parties, students. Okay. Perfect. So what we conclude here is that these forwards are actually over the counter contract. Now, what do we mean by over the counter? Over the counter means something which is happening, let's say, between two parties sitting on a table, right? It's kind of a customized contract. So let's say party A has one requirement, party B has the ability to satisfy that requirement, and that requirement will be anything. So they will enter into a specific customized contract for each other. That is called as over the counter contract. It's not necessary that it's a standard contract. So hence we say that this is a highly customized to suit the buyer, to suit the requirements of a buyer or a seller, student. Yes. Now coming to futures. I hope the forwards are clear, students. Yes. So Abrikesh is asking only OTC in forward. Yes. Because if it is no OTC, if it's not over the counter, then it will become a standard product that we will study under futures, right? Because what happens now in today's world, if you go to the bank also, right, and ask them that I want to enter into a forward of certain US dollars, forward, let's say, to sell the US dollars to the bank. So the bank will come up with some of a customized solution for you, because how much quantity you need, what date you want the delivery, or what date you want to sell to the bank, all those things will be very much customized, students. Okay. Now let's come to the futures. So futures also are very much similar to a forward contract, students. Okay. wherein some future date, some execution will have to happen. For that, we will enter into a contract today. Okay. However, there are some specific things which are specific to futures, which are not there in a forward. So these are the standard contracts. As I said that in forwards are not standard contracts, but futures are. Reason being, futures are traded on a stock exchange. Now, for something to trade on a stock exchange, you cannot have different terms and conditions, right? The terms and conditions of the contract will have to be very much consistent. Now, what do we mean by standard contract, students? Standard contract is that the quality and quantity will be very standard, right? It will have a lot size. For example, let's say 5 is the lot size. That is the quantity, students. Okay, so that lot size is very much standard. Now, if you want to have a 2.5 equivalent quantity, you cannot do that. Similarly, if you want to do 10 equivalent quantity, so then you will enter into two contracts because 5 is the lot size for one contract, right? But in case you want to do 7.5, you cannot do that. Either you will have to do one or either you will have to do two. So these are called as a standard contract, students. Then in this case, mostly we have seen that the settlement will happen on a net basis. As I said that, students, there are two ways to settle. One is the gross base, wherein the delivery is taken and amount is paid. And second one is the net basis. In the net basis, only the net payoffs are paid or received. In this, no actual delivery happens. So in this example, students, can you tell me, in case one, had it been a case of net payoffs, how much amount procurement manager would have paid or received in case one? Tell me, students. In case the settlement has to happen in a net basis, in case one specifically, procurement manager will receive or pay, and what amount will be received or paid? So Abrikesh has responded yes. So the procurement manager will receive rupees 5. Uh, it can be or it cannot be, Abrikesh. It will not impact. So Abrikesh is asking, can there be different lot size for the same future? Practically, I don't know because I don't deal in them, but it won't make a difference, correct? So received rupees 5, yes. Then in the second case, tell me, what will supplier receive or pay? I'm talking about from the supplier's point of view. What will supplier receive or pay? For the second case, if this contract has to be settled in net. I'm waiting for you guys to respond, students. Yes. Supplier will receive 15 rupees. Abrikesh has responded. Very good. I'm sorry. Sorry. Yes. So this is how the futures settlement on net basis will happen. And lastly, futures are traded on a stock exchange, right? Very specifically, these futures, why and the entire genesis being standard contracts is that these are required to be traded on a stock exchange, students. I hope now the basic concepts of forwards and futures are clear, students. Then we discussed about the shares of X Limited. Shares of X Limited as an underlying, and there is a forward for a 6 months of expiry and into 455 shares. Whatever price they want to put, they can put. This is a over the counter contract. That is where the purchase happens after 6 months. The amount is paid and the shares are received. Okay. However, in case of futures, there are three different lot sizes, 1, 2, and 3, with different months expiry and different lots. Sorry, the lot size is 1,000. And price will be something that is appearing on the stock exchange, which is a very standard price. I mean, which is a very standard contract, not price. Price will keep on changing. Now, futures on X Limited equity, here, the net payment will happen. As we discussed, whosoever will be the person who will gain will receive the funds, and the person who is losing will pay for the funds. So typically, Abrikesh, what we have seen is mostly the forwards on the over-the-counter market are entered by the banks. Okay. So mostly banks enter, and hence they will, and they also have some set of specific conditions with them, but that's how it happens. No, it's an individual, it's possible, but individual will not be able to undertake any sort of a risk, right? Because while entering into a forward, if as an individual capacity, now for example, if I am saying that okay, I will issue forwards to someone who comes to me, so I will not have that risk taking capability, right, with me. What banks does is that banks will give a forward. Why banks will enter for a forward to sell here, and similarly they will enter into a forward to purchase there. So they will manage their position because they are getting large number of contracts, right? That is why it happens through banks. Hmm? So for a stock exchange, we understood that there is a X, Mr. X, who places a request to buy futures. We're talking about futures here, students, not the underlying. And Y places a request to sell the futures. And let's say it is a future on SBI Bank's equity share. Okay. At a given point of time, there are three different maturities that are running: 1 month, 2 month, 3 month. Okay. Practically, what happens is on the last Thursday of that month, the expiry of these futures happens. Okay. Now the settlement will happen. Okay. Let's say the contract was entered at 110 in the stock exchange. Now the price becomes 115. So Mr. X, who has bought the futures, will have a 5 rupees of gain. Correct? Because the prices has gone up, and hence, had, X not entered into futures, there will be a loss. So because of this contract, there is a gain of rupees 5 to X. And similarly, there is a loss of rupees 5 to Y. In the second case, let's say the price becomes 95 students. In such a case, 15 rupees will be a loss to the buyer and 15 rupees will be a gain to the seller. Now, using this, can we devise some strategy, or let's say, can we have a deeper, you know, outcome of this entire discussion? Okay, now tell me. If you see to the bottoms, in case one, if we are expecting that the price goes up in the time to come, what action will you take in the forward or futures market? Whether you will buy a forward or whether you will sell a forward. Yes, very good, Abrikesh. Is there anyone on the query handle also if they want to report? Yes, we will buy the futures in case the prices is supposed to go up. Because today is 100 and it might reach to 120 while you have entered into a buying position of a forward or future. Whenever the prices are going up, you are getting a benefit, students. Then case number 2, students. Price is expected to go down. Then what will happen? If you expect that the prices are going to go down, what you will do? Whether you will buy it or whether you will sell it. Yes. Applications again, you're right. You will sell it. Because selling the future means that today you are taking a short position. So selling means you're taking a short position, buying means you're taking a long position. So these are the terms sometimes the question also uses. So anything which we have bought, right, or which we have purchased, we call it as a long position. Anything which we have sold, selling, is called as a short position. Now, students, think about from the cash market or the spot market perspective. Okay. We will go to the other market later on. For a cash market or a spot market where we deal with the underlying, what actions will you take? First of all, you will buy and then you will sell, right? That is how it happens. That is why we call it as you take a long position for purchasing and then you sell it. Is there a possibility of selling first and buying later? Let's say today, I understand that the prices are going to go down. Today, I'm standing at 100. And on day 30th, I understand the prices will go down to 90. So, can you also, and you're very sure that this will happen. So, what can you do is you can sell today at 100 and buy on the 30th day at 90. So, your buying has happened at 90, selling has happened at 100. You will still be able to make a gain of rupees 10. But whether this is allowed to do, this is not allowed in the cash market because, yes, because you cannot sell what you don't have. Because what will happen now after day one, on day two or day third, as per the settlement mechanism, you will have to give it because you have sold, right? You have sold, so you have to present it for the settlement. Now, if you don't have anything, what will you present for settlement? So in intraday, I mean, in different days, buying and purchase, selling first and buying later is not possible. But within the same day, selling first and buying later is possible. Okay. Now, let's come to futures and option market. In this, you are buying futures. That is okay. If you understand that we can buy futures, that is relatively simple. But can you short sell the futures? Yes, because as I said that futures is a derivative and derivative is a contract. Now, in that contract, can you enter into a selling position? Yes. Even if you don't have that underlying, the answer is yes. Because you are not the buyer or seller of the underlying, but you are the buyer or the seller of the derivative itself, students. Right? That is why the short selling in a derivative market is very, very easy. And that is why it is very, very risky also. Right? So as we discussed on day one, this is the position, day 30th, this is the position, and 21 will be the net amount that will be received. Now let's draw out the difference. I hope this is clear, students. Where is short selling allowed? Where is not allowed? What are the... Yes, Abrikesh is saying intraday in spot and futures. Yes, intraday in spot market and futures, it can happen intraday also. It's not only intraday. Any other questions, students, till now, or shall we move ahead? Sorry. Let's clearly then discuss what are the three differentiating factors for cash segment, forwards, and futures. Cash segment is actually the spot market for the underlying itself. Forwards are the customized OTC contracts that are settled on actual basis on a gross basis, right? Futures are very much standard contracts that are traded on a stock exchange and settled on net basis, students. Now let's come to pricing. Pricing is actually the compounding. Okay, now in pricing, students, okay. Now, let me give you a brief. We are talking about the future or forwards, right? Now, what are these futures or forwards in terms of the value, if you want to say? They derive the value from the underlying. Now, the underlying is the value as on today. It's the present value, right? And future or forward, as I said, that these are the contracts that are to be settled after 6 months, after 2 months, after 3 months. That means there is a time value of money involved between today and that settlement date, right? Now, if we have to arrive at that future value, we will just simply take the future value is equal to present value multiplied by 1 plus r raised to the power t. Clear? So this is a normal annual compounding formula, students. So Abrikesh is asking something. We should use P is equal to principal instead of present value of NPV. No. Okay, I'll tell you why we are using present value here is that, see, principal can also be used. I'm not denying that. Okay. However, why I'm saying the present value? Okay, first of all, net present value is something that is different because it has a word added net. Net present value means cash, present value of cash inflow minus present value of cash outflow. right? So it's not a net. The present value simply means only a present value of either a cash inflow or a cash outflow, right? It's just denoting that it is a value as on today. Now, the reason being we are telling this is the present value is because it's in the spot market. Okay. And A is the future value. Okay. So 1 plus R raised to the power T. This is a very simple formula, right? Related to the compounding. Now let's understand about the semi-annual compounding. Or we will give you a formula which will be useful for any compounding for less than 1 year. So student, in practical life, you would have seen that at max the compounding happens for 1 year or below, right? It cannot be, let's say, compounding is happening after 2 years. That is not right as a principle. So let's say any compounding that happens up to 1 year or less than 1 year, this formula can be used. What is this? Now let's say R, which is the rate of interest, is 18% per annum. Then we simply used this formula. And semi-annual compounding means that after 6 months, the interest will get added to the principal and again the compounding will happen. So hence it is raised to the power 2 and 18% divided by 2. So we come across this equation wherein R divided by N and raised to the power T multiplied by N. Now these are all things are similarly okay. Now these two things got introduced. One is T. T is specifically mentioned as for 1 year, students. And N is equal to number of times compounding in 1 year. Now semi-annual means 2 times the compounding will happen in 1 year. Okay. And this T is equivalent to 1 year. If let's say the time period is 3 years, so T will become 3. Okay. Now, for example, time is 3 years and compounding has to happen 4 times a year and rate of interest is 10%. So 10 divided by N, which is 10 divided by 4 into raised to the power 3 into 4. 3 years and 4 is the number of times compounding has to happen. Okay. So this is a very easy and simple way to calculate the compounding. Yes, students. Then there is a concept of continuous compounding, students. Now for continuous compounding, A is equal to P into E raised to the power R T. Now again, A is the future value, P is the present value, R is 1%, R is the percentage of discount, and again T is equal to 1 year. Now what does this continuous compounding means? Continuous compounding means that every millisecond the compounding is happening. Okay. And E, we all know there is a value attached to it, right? There are E tables. So E raised to the power RT is used where the compounding is happening to the infinity level. Okay. Now in terms of valuation, so first of all, we understood about the regular compounding and continuous compounding, students. Now let's talk about the forwards or futures. Now the valuation for a forward or future is actually the spot price moving to the future price. Okay. So the price of a forward or future is equal to the future price of the spot price. So spot price is today's price. For that, we will do the future price. Now, the expiry will be used for calculating the time period. And we understood there are two types of compounding. One was a discrete compounding. Discrete compounding means which has a, let's say, fixed time period for compounding. For example, A is equal to P1 plus R divided by N raised to the power Tn. Okay, let's say it has a fixed intervals of the compounding. But continuous compounding has no intervals. It is getting compounded every millisecond. So A is equal to P into E raised to the power R T. Now let's say today on 8th Feb 24, spot market, the price is quoted as 10. In the futures market, it will be quoted, let's say 11, 12, 13, depending on the expiry. Let's say 1 month, 2 month, 3 month. So in a way, 11 is actually the future value of rupees 10 after a month. Simple. And whether you use continuous or discrete compounding, that will be given in the question. Now, this is important actually. So students, if you see, there are two different elements, dividend and transaction cost. Now, between today, where we are standing, and the exact expiry of that forward or future, let's say 6 months from now, there can be certain events that can happen. One is the dividend might get declared. Second is, as on date, while entering into this, there will be a transaction cost involved. So what we do, in case the dividend is expected to be paid, our spot price already includes the present value of that dividend. And more importantly, the dividend is paid on the underlying, not on the future or forward. Correct. So, for example, a company has issued 1,000 shares, and on those 1,000 shares, there is another 1,000 futures that are traded. Now, can you tell me the dividend will be paid by the company on 2,000 equivalent shares or only 1,000 kind of shares? Yes, tell me, come on, students. So the question is, a company has issued, so Abrikesh is asking to repeat, a company has issued 1,000 shares, right? And there is another 1,000 futures that are traded on those shares. So in totality, the company will give dividend on 2,000 worth of shares or only 1,000 worth of shares. So will it include the futures also while paying the dividend or not? Yes, the correct answer is 1,000. Reason being, the derivatives are not issued by the company. Only shares are issued by the company. And hence, what we do finally is, sorry, just a second. What we do finally is we will reduce the present value of this dividend. Why we are reducing it? Because futures will not get benefit of this dividend. Secondly, the existing price includes the dividend as well, multiplied by the compounding factors. Now, there is a transaction cost, students. So transaction cost gets added, right? That is what we have done here. Now, what about if there is a continuous dividend, students? This is very, very important. So continuous dividend, if it is Y, so generally what happens, students, like we have discount rate of R, right, which is the rate of interest, the dividend yield can also be calculated. Let's say the dividend yield is 5%, 6%, 7%. So it denotes how much dividend you pay in relation to that of the market price. That percentage is calculated and it is called as the dividend yield. And it's a continuous accretion. It will happen at a continuous rate, students. That is where it will get reduced here. Okay, so this is the formula, students. R minus Y. So R will increase the value and Y will decrease the value. Yes, now this is very, very interesting relationship. On expiry, the price of the futures will become equal to the price of the spot. Because now there is no future value, present value concept left. Now exactly on the expiry date, it will become similar. So this chart also shows the same. The expiry is here. Let's say here is the expiry. And this is the price. So the line that you are seeing is the future price. Actually, this is a difference in future price and spot price. The difference will keep on coming down. Okay, students, I hope the understanding is clear till now. If there is something else, please do ask, students. Okay, let's move ahead. Now, what are the uses of such derivatives? Now, students, till now, we have got a very good amount of knowledge on forwards and futures, how to value that forwards and futures. What are now the uses of such forwards and futures is what we are going to cover it now. First is speculation. Now, what do we mean by speculation? Speculation is actually some anticipatory gain or anticipatory loss. So hope of gain and risk of loss. There is a long position on the futures of X Limited that we have taken. So that is around 80 into 1000, 80,000 rupees. Okay. And here we are taking an example of the short position. Similarly, what we need to do is we need to deposit 20% margin to the stock exchange, students, right? Because we have to operate on some margins. So that 20% we have to deposit. Now let's say tomorrow the price becomes 70. Entered price was 80. So 10 rupees there is a loss. Minus 10,000 will be adjusted from the margin. Only 6,000 rupees will be remained. In case there is a gain, because the price has moved up to 90. So this 10,000 rupees plus 16,000 in totality, the person will get 26,000 rupees. Now, in case of a short position, if the prices goes up, students, there will be a loss. Correct? Because I have taken a short position at 80. The market is giving us 90. So don't you think I have made a loss by entering into this future? Because had I not entered into this future, I would have been able to sell it at 90, which is 10 rupees higher. So there is a loss of 10,000 against 16,000 of the margin. The prices goes down. In case of a short position, the person will gain. So this is just simple speculation, right? Now in speculation, my anticipation says that the prices will go down, then I will take a short position. But if by any chance the prices goes up, then it will lead to the loss as well. So Abrikesh, what will happen in either case of gain or loss? So Abrikesh is asking in either case of gain or loss going above margin, how will it be recovered? Simple. If it is a loss, it will be adjusted from the margin, and the person is required to again pay another 20% of the readjusted portfolio, whatever he or she is handling. And if there is a gain, it will get added. Okay, there was one question also on this margin, wherein the margin also keeps on changing basis your revised value of the portfolio. Now, this is important, students, hedging. Now, in real life, lot of futures or forwards are used for hedging. Now, what do we mean by hedging? This, and it is very much different from speculation, because hedging is that you already are exposed to a risk, right? That risk can be for anything. It can be due to the any sort of the underlying. For example, equity shares, if you have bought of any company, then you are exposed to a risk of the prices going down. Similarly, foreign exchange, similarly, other things, right? Hedging against the risk by using forwards or futures. Hedging means protection, right? We are already having one position in the spot market, and against that, we are having the other position in the derivatives market. Now, here we have taken an example. Let's say equity shares on X Limited are being held in the spot market by any person. The risk is there that the prices will go down, and ultimately this person will lose. So for protection, how can we protect in case the prices goes down? How will a person be able to gain in case the prices goes down? The moment they short sell the futures, they short sell the futures in the futures market. And hence there is a and hence there will be a gain whenever it goes down. If the prices goes up, it will be a gain in the spot market and loss in the futures market. So limited earnings and limited loss. Okay. Now I think this was the example. I'm not again going through this because we have understood how to calculate this. Okay, so we were saying that X Limited. No, this we have I think discussed. Let's say any underlying can be BSE NSE index, Sensex or Nifty, right? I think we're trying to explain here with some of the things on the beta. So what happens, students? For example, in some of the questions of the NIF, in some of the questions, if we are trying to hedge any position of a equity share with using the index futures, then we have to use beta, because beta is a sensitivity of measurement of how much X Limited will change with response to the change in the market. But the moment we are trying to understand that how many contracts of index futures will be needed to fully cover the X limited's movements, we need to use make of this relationship. Now, this long position is the contract to buy on expiry. Short position is the contract to sell on expiry. And what is this contract? This is a derivative. And here the expectation is that the downside risk will happen. And here the risk of upside will happen. I think some of the questions have come. Now, students, if you want me to do any specific question, you let me know. Otherwise, we will do these questions once we cover the concepts. Yes, so I think let's do in between a question number 4. Let's revise this. Yes. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio of shares in 90 days. So he's expecting to purchase a portfolio of shares in another 90 days. However, he's worried about the expected price increase in shares in coming day, and to hedge against this potential price increase, he decides to take a position on a 90-day forward contract on the index. Now, students, if he wants to hedge himself against the potential price increase, which position he needs to take? The question only says that position. So my question is whether he should take a long position or short position. Come on, students, tell me. Yes, Abrikesh. Long position. Very good. The index is currently trading at 2290, assuming that the continuously compounded dividend yield is 1.75. See, they have also given us the continuously compounded dividend yield. And the risk-free rate is 4.16%. This is the discount rate. You are required to calculate the justified forward price on this contract. Suppose after 28 days of the purchase of the contract, the index value stands 2450, and then determine gain or loss of the above long position. So in a way, question has indicated here as well that there is a long position. If at the expiration of 90 days, the index value is 2470, then what will be the gain on long position? Simple, students. They have given us the E values. So what we are going to do first? So what is the spot price? 2290. Dividend yield is this much, risk-free rate is this much, and both of them are continuously compounded. So we will make use of this formula, P into E raised to the power R minus Y multiplied by T. We will put the numbers in this formula. Time period will become 90 divided by 360, and 2290 is the current one. E raised to the power, this thing is given in the question as the value, and 2303.65 becomes the today's, no, not today's, this becomes the future price, which is called as the theoretical forward price, and this we also called as no arbitrage price. We'll understand what do we mean by arbitrage. So after 20 days, what will be the gain or loss on the long position? So students, if you see 2450 is our index appearing on that day. And what will be my future value be becoming? We have to just take after 28 days, what will be my today's spot price? Today's spot price is 2290, right? So this will become 155.76 rupees as gain because I've taken a long position, students. By taking a long position, I'm getting a 155.76 rupees gain. Now gain on maturity. What is the maturity value? 2470 minus the contracted price 2303.65. So this will become my gain or loss on the maturity. So this is the overall. Why? Because 2303.65 is my contracted price, students. This one. This is our contracted price. And this is the maturity price. Sorry. Clear now, students? So this was one of the good questions on how to calculate the gain loss, theoretical minimum price, and other things. Okay, students, now let us break for 10 minutes. We will again reconvene back, okay, and start our other topics. So welcome back, students. Now let us start with the next topic. Yes. So in this, we will be elaborating further on hedging part. So student, we said that in hedging, we are protecting against the risk that the entity is already exposed to. So there is one risk that an entity is exposed to, and using derivatives, we are trying to protect against that risk. How? We have taken an example wherein X Limited equity shares that we have purchased in the spot are hedged using the X Limited's futures that are trading in the market. So let's say we have a 1 lakh long position. In futures, can we take 1 lakh short position? Yes. So that is the hedging. However, the second case, we want to hedge equity shares using the index futures. So we'll have to make use of beta. Reason being, the changes in index future will not be equal to the changes in the X Limited's equity shares value. That is because of the relationship between both of them using beta. So for example, beta is 1.2, market index moves by 1, X Limited will move by 1 by 1.2. That is what we mean by beta, right? Similarly, beta is 0.8, then 1 and 0.8. If the market moves by 1, X Limited will move by 0.8. So there is a thing called same stock, right? Which we discussed in the A part. So in the cash and derivative markets, we take equal and opposite positions, students, right? If we have taken in the cash market 1 lakh long position, in the derivative market, we will take 1 lakh short position. So take equal and opposite position for achieving the hedging for the spot market, right? Because in a way you are hedging your spot market here. In the B part, if we are hedging through the market index, students. Okay, Abrikesh, we will go to question number 6. Okay, then we will answer your question. Then through market index. Through market index, we mean what amount will be answered by this beta minus required beta into value of portfolio. What happens that sometimes we say that beta is, let's say, 1.5, but we are okay to have a beta of 1. Then in that case, 1.5 minus 1. Or else, in some of the cases, it also says that beta we need 0. So then the required beta will become 0. Entire 1.5 will get here. So if beta is positive, students, if beta is positive, then we will take the opposite position. And how much will be answered by this? Okay. If beta is negative, then take same position because beta is already negative. If the market moves up, the share moves down. So hence we will take the same position. I hope it is clear. In case it happens through a market index, which position we need to take and what amount we need to take. Amount is using this equation and position is by analyzing whether the beta is positive or negative, students. Now comes question number 6. Yes. So question number 6, students. On January 1, 2018, an investor has a portfolio of 5 shares as given below. A, B, C, D, E. The price is also given, the number of shares are given, and beta is given. The cost of the capital to the investor is 10.5% per annum. You are required to calculate the beta of his portfolio. Sorry. In the question from Abrikesh was, in question number 6 for beta of portfolio, it is required to calculate weight, or we can directly multiply number of shares by rate by beta, then total up and divided by the value of the portfolio. Wait, let me just see. I think that also you can do. So here what we are doing is, we are first calculating the value of the portfolio, right? Price into number of shares. Price multiplied by number of shares. And then this is the value that is getting arrived. Similarly, these all values, this is the value of the portfolio. This summation becomes value of portfolio. Okay. And then basis that we have arrived at the weight and beta. So Prikesh, what you are saying, we can also do that. We can just multiply the price multiplied by number of shares multiplied by beta. We will come to the number, right? Then we can total it divided by the value of the portfolio. Again, the value of the portfolio will be calculated using this, right? 188, 54, 860. It will give us the same answer. Okay. Then next part, let's complete this. The first part is clear. Okay. Now the second part is the theoretical value of the Nifty futures for February 2018. The number of contracts of Nifty the investor needs to sell to get a full hedge until February for his portfolio. The current value of the Nifty is 1500 and Nifty futures have a minimum trade lot requirement of 200 units. Assume that the futures are trading at their fair value. The number of contracts, the number of future contracts the investor should trade if he desires to reduce the beta of his portfolio to 0.6. So this is a good question, students, right? Now, for calculating the theoretical value of Nifty futures, we understand that what is the cost of capital is 10.5%, right? So this is our discounting rate for future and present values, right? And what else we are given? We are given yes. So we have been given natural log of 10.5, which is 1.105. So students, if you see, E has an inverse relationship with natural log. Okay. So the reverse of natural log will become E. That is what we have tried to capture here. So the current price at which Nifty futures are trading is 5900, students, right? So 5900 into E raised to the power 0.0998 multiplied by 58 divided by 365. Okay, this has come from here. Okay. There is one more catch here. I'll tell you. So this 10.5, first of all, is a annual compounded rate. So this has been converted to the continuous compounding rate using this 0.0998, which has become 9.98. Then using that continuous compounded, we have arrived at the E value. Okay. So the A's value will become, the future value will become, the index future value will become 5994.28 students. And now they're saying in the last part, the value of the portfolio beta to become 0 point something. No, okay. The first they are asking to calculate the 100% hedge. That will be calculated using value of the portfolio multiplied by portfolio beta minus required beta divided by the future contract value. This is my value of the portfolio. This is the portfolio beta minus 0 divided by the contract price multiplied by the number of units. So 13.35, in a way 14 contracts. And when the portfolio needs to be reduced to 0.60 portfolio beta, then it will be 4 contract units. Clear? Yes. This was another key takeaway that we discussed in our previous session. I mean, in the recorded lectures were overpriced. If something is overpriced, you will sell that. If something is underpriced, you will purchase it. If you feel that future is overpriced, then also you can short sell the futures. But at the same time, take a long position in the spot market. Correct, because you feel that it is overpriced, but tomorrow if the prices are still increasing, then so to cover up that, you can have a long position in the spot market. For doing that, you need to have to borrow the money. Now, in second case, let's say futures is underpriced. Then you will purchase the future. For purchasing the future, take the opposite position in the spot market. You will have to take a short position. So can you take a short position today? No, as we discussed. So for that, you will borrow one share and then sell it in the spot market to arrive at a short position in the spot market. These are also hedging techniques. If we come to know that what is overpriced and what is underpriced, and accordingly do. So, Abrikesh, it happens. I can borrow the share and I can tell to the holder, or let's say the person who has given me that share on a borrowing basis, that I will return back to you the share after this much of time. It happens. Okay. Now let's come to the critical discussion of the options, students. So options, we have understood using the below two diagrams. The first one is a call option, wherein A has a right, sorry, A is again an instrument. Okay. A is again a financial instrument or a contract which bears the right or an option. What is a right? Okay, first of all, do we understand the difference between right and a duty? Yes. Duty is some sort of an obligation that I have to perform. Right is something that I am entitled to receive. Okay. So right slash option. Option is something that I have an option, whether I want to do or whether I don't want to do. But it's not an obligation. As I mentioned here, no obligation, or it's not a mandate. I am not mandated or compulsorily asked to do such things. Okay. So imagine some product called A having these features. Now, right of what? We understand that there is a right, but right of what? Right to buy. Again, to buy what? To buy an underlying asset, students. Now, what do we mean by that underlying asset? Again, as I said that any derivative has a standard feature. What were they? Or as I discussed that there has to be some certain things in a contract. What are those certain things? Specification of that underlying asset, the quantity, the quality, everything, right? So this underlying asset is, let's say, X Limited's equity share. Again, so now let's finish it here. Finish it till now. A, which is a right to buy an underlying asset at a specified price, which is called as a strike price. Now, let's say I give a option or a right to buy underlying asset. Okay. But at a specific price. And as I said that the one more feature of a derivative is that it has a expiry, right? It has a time period attached to it. So in this context, in the call option context, it can take two forms. One is that it is up to an agreed date or as on that agreed date. If I say that you have a right to buy X Limited's equity share at rupees 100 anytime up to 3 months. Okay. This language is clear. Now, the second language, you have a right to buy X Limited's equity share at the rate of rupees 100 only as at the end of the third year. Sorry, of the third month. So, do you see the difference between both of them? Everything is same except to the fact that in the first sentence, I'm saying that you can buy up to an agreed date, up to 3 months. In the second sentence, I'm saying that you can only buy on the third month end, not before that. So this right can take both of these forms, students, whether up to or as on. But these conditions will remain same. Right to buy an underlying asset at a strike price. This is called as call option. Now, A is a right to buy. So again, I'm saying call option is what? Please don't confuse call option with the underlying. Underlying can be anything. It's a very much different contract. Only thing is the value is dependent on the underlying. Correct? So A is a right to buy X Limited's equity share at rupees 100 per share on 90th day from today. Or the second language I have mentioned below is this one, up to. Clear? Now let's come to put option, students. So put option, students, specifies, again, I have taken B here just to distinguish between A and B. So put option is again a right or an option, but not an obligation and not a mandate. To do what? To sell here, students. Call option was to purchase, was to buy. Put option is to sell. Sell what? Again, an underlying asset at a strike price, at an agreed date, or up to an agreed date. Simple. Everything is same. Only thing is in put option, it's a right to sell. Call option had a right to buy. That's the only difference. And I'm telling you that the seller or buyer of this right will be different than the seller or buyer of the underlying students. That we will discuss how. Okay. So tenure, let's say, is 3 months. 0, 1, 2, and 3. So date of entering into the contract is the 0th day, which is here. Now, as I said that there are two ways an option can be written, or let's say the terms can be specified. The first way is at any time up to 3 months, the person can exercise the right. So these are called as American options. Let's say on 60th day, 90th day, whenever there is a better deal, the person can enter into that contract. The second types are European options, which can only be exercised on the expiry, which is on the 90th day. So Abrikesh is asking, how can we specify American or European? So Abrikesh, if the terms are such that it is going to it is going it can be exercised at any point of time, then it is an American option. But on the contrary, if the terms are such that it can only be exercised on the 90th day or on the expiry date, then it becomes a European option. And it is very much specified in the contract. Okay. Now the parties to the option. This is again very, very important, students, because a lot of us have a confusion here. And if we understand it right, I'm telling you that the entire concept of options will be a cakewalk for all of you. So let's first understand the right to buy related derivative, which is the call option. Now, as I said that in the standard features of derivatives, there are buyer and seller who are very much different than the buyer and seller of the underlying. Now, right to buy, if someone purchases a call option or if someone sells the call option, right? So the buyer here is actually buying the right, and seller here is the seller of the right. And right of what? Right to buy. So buyer is buying the right to buy. Seller is selling the right to buy. Okay, he's still selling the right to buy. And I've mentioned categorically here not to be confused with the buyer of the underlying. It can happen later on. Whosoever is the buyer of the underlying or the seller of the underlying, that's a different story. But don't relate it to the buyer or the seller of the underlying. We're only talking about the buyer of right to buy. And here also seller of right to buy. Now, what will happen on expiration or settlement? This buyer of the underlying and he will become the seller of the underlying because the buyer of the right to buy will exercise the right if at all it happens, then he will buy the shares, right? Because he has the right of buying the shares. So in this case, he might become buyer of the underlying, and in this case, he will become the seller of the underlying because he has sold the right to buy to some person, and now they have exercised that right. Now let's talk about right to sell. Now let's come to the put option, students. So in case of a right to sell, buyer is a buyer of right to sell and seller is the seller of right to sell. Now tell me, students, on expiration or on settlement, this buyer of put option will become what of the underlying? Will he become the buyer or seller of the underlying? Let me repeat the question. The buyer of the right to sell, or let's say the buyer of this put option on expiration or on settlement will become the buyer of the underlying or seller of the underlying, students. Yes, I think we've got the answers. Will become the seller. Perfect. Very good. And the seller of the right to sell, I'm selling the right to sell, I will become the buyer of the underlying. Clear? Yes. Now there are other terminologies that we use. We say that the buyer of the right, and here right means any right, right? Right to sell or right to buy. Both call and put. We are talking about both call and put. It becomes the holder of the option. We say them as the holder of the option. Seller of the right becomes the writer of the option. And again, for right, we are telling both call and put. Seller of call option is equal to the writer of call option. Seller of put option is equal to writer of the put option. So these are the two standard terminologies that are used in the options discussion. Okay. Then Mr. A is a holder and Miss B is a writer. Now let's take our discussion here, students. Now Mr. A is a holder. Now, Mr. A has actually purchased the right to buy, or Mr. A has purchased the right to sell. That is called as call or put option, right? And Miss B has written that option, has sold that option to Mr. A. Now, what will Mr. A say? Mr. A will say, okay, let's come to the premium discussion later. No, okay, let's first discuss this. So, Mr. A will say that, or let's say Miss B will say to Mr. A that, I'm giving you a right. Now, for that right, you need to give me some consideration. That is called as premium. So, you would have understood about some of the insurance contract, students. How does an insurance contract works? Under an insurance contract, we pay insurance premium to the insurance companies, and insurance companies give us a right to claim the money in case some losses happens, right? So in a way, insurance company also is saying to you is, if I'm giving you a right, if I'm selling you a right, you need to give me a premium. Since Miss B has sold a right to Mr. A, Mr. A will give a premium to Miss B. Now strike price is 110, spot price is 100, and time to expire is 3 months. And this we are talking about a European option. Now, spot price can be different, right? Okay, tell me, students, whether strike price is bound to change. During this 3 months, is strike price bound to change or it will remain same? Yes, very good. Abrikesh is saying same as contracted. Perfect. Let me see anything on the query handle. Nothing. So it's a it will remain same as the contracted price. It will not change. The strike price is remaining same. The spot price will keep on changing. But as of now, let's start with the spot price of 100. So X limited is the underlying asset of that equity, right? So in a call option, there is a right to buy X limited shares after 3 months at the rate of 110 per share. So Mr. A has paid a premium of rupees 10 to Miss B. And as I said that this premium is defined as cost of giving the right. Miss B is the writer or seller, students. And Mr. A is the holder. Now on expiry, what will happen? There are three possibilities, students, that we have taken. One is the spot price moves higher than the strike price. The second case, spot price comes down compared to the strike price. And third one is strike price is equal to the spot price. Now, if you understand here, the price in the spot market has gone to 125. Now, Mr. A will say that I have a right to purchase this share at 110. I have a right. for which the market price has gone to 125. So I am having a gain of rupees 15 because of this contract. Correct? However, in the second case, the price has gone down to 95. Now, in this case, Mr. A will say that I have a right to buy at 110 for something which the current price is quoting as 95. So, do you think it's a right anymore? No, it is not a right anymore. It has become an obligation for me. This contract has become an obligation. But since this is a right, this is not a future or a forward. So, I will not exercise this right. And hence, I will not lose anything. I will not make a loss on the options. Had it this been future or forward, I would have to settle this as a loss. That's the real difference, students, between the options and futures or forwards. Because in options, you have a right, you don't have an obligation. In case it becomes unfavorable to you, you can leave it. So this is also out of the money and no exercise will happen. If the spot price is at 110 and the strike price is also at 110, then it is called as at the money. Holder is neutral to exercise. Whether holder wants to exercise, he will exercise. If not, then no exercise will happen. So students, we call this situation as in the money situation. This situation is out of the money. The contract has gone out of the money because there is a loss now to the holder. So this in the money, out the money is always seen it from the perspective of the holder, whether holder is making a loss or a gain. In the money, holder is making a gain of 15. Hence it is in the money. Now let's come to gross settlement. In other Abhikesh is asking two things. In other words, they are opposite. I think you're talking about futures and options, right? So futures in a way is a mandate. Whether the price is up or the price is down, it has to be settled. But options is a favor, right? It's an option, it's a right. Whether you want to exercise or not, it is totally dependent on you. And any which ways, the biggest reason for exercising it or not exercising it is actually the spot price compared to the strike price. If it is in a favorable mode, we will exercise it as in the money. And if it is not favorable, then we will not exercise it. When spot is equal to strike, then it's neutral to you, right? Whether you want to exercise or not, it will not make a difference. Why holder exercise when he has already paid rupees 10 as premium? I think you're asking about when spot is equal to this. No, we have to see it from the future incremental cash flows, right? Okay. Now I understood what you're saying, Brikesh. You're saying when spot is equal to strike, then 10 rupees is already paid as premium. I'm saying yes. 10 rupees is paid as premium. However, whether you exercise or not exercise, the net payout will become zero, right? So it's neutral for you. Now let's come to the gross settlement, students. So on gross settlement, Mr. Mr. A, right? Huh. So pay 110 and receive one share. In this case, nothing will happen. So one, if the price is 125, the price is 95, and if the price is 110, that's how it has been shown. So 125, pay 110 and receive one share. In the case of second case, where 95 is the price, nothing, and 110, nothing. Net settlement. So receive 15 rupees simple. And on inception, there is a payment of rupees 10 premium. So the net gain slash loss, here it is a gain and here it is a loss. And for Miss B, from the writer's perspective, in the first case, there is a net loss. Then in next two cases, there is a gain, students, right? Because the option has gone out of the money or at the money, and hence it has not been exercised. Clear? Let's move ahead. Now with this, students, we understand that loss to a option writer is unlimited. Sorry, sorry. So the loss to a option writer is unlimited. Similarly, gain to a option holder is also unlimited. And gain to a writer equivalent to the premium amount is limited. This maximum up to the premium amount. And similarly, loss to the holder is also limited, students. See, one thing is very important. Loss of one will be equal to the gain of another one. So if loss is unlimited to the share right to the option writer, that is why, because option writer is exposed to the unlimited movement of the prices. Yes, students. So what I was saying is that the loss to the writer is actually unlimited because writer might witness unlimited movement, correct? And hence a payout according to that. I hope this is understood, students. Now let's discuss about put option, students. And I will expect you guys to answer now. Let's say the put option is at a strike price of 110, spot price being 100. Time period is 3 months and it's an European option. And we're talking about the X Limited shares, right? Now, Mr. A is a holder of put option and Miss B is a writer of the put option. Now, tell me, students, in the first case, if on expiry, the spot price moves to 95, then Mr. A will gain or lose. Come on, tell me, students. For a put option, the strike price is 110. Mr. A will gain or lose if the spot price becomes 95. Yes. Sorry. Yes. Sorry. So Abrikesh and Viraja reverted. Is there anyone else who can? No, I think, yeah. So, sorry. See, first of all, students, there cannot be any loss to Mr. A. I can tell you because Mr. A is having an option. Yeah, sorry, students. So, what I was saying that Mr. A cannot have a loss because Mr. A is having an option. Wherever he feel he will incur a loss, he will not execute that option. Now, let's think it from Mr. A's perspective. Mr. A is having a right to sell. Right to sell X limited at 110. Okay. Now, if that right to sell is at 110, the market price is at 95. Don't you think Mr. A is in a favorable position? Yes. Reason being that he is able to sell at 110 of what is there in the market at 95. And because of this contract, he's able to make 15 rupees more. So that is where we call this as a gain as in the money option for Mr. A. Now let's talk about at 110. Now 110, whether he wants to execute or not, it will remain same because it is at the money, right? 110 is the strike price and 110 is the spot price. It will remain same. Now if it is 125 for Mr. A, then it's not a loss. It will be called as out of the money, but there is no loss except to the premium that he has paid. But there is no loss to Mr. A. Because if it is a loss, he will not exercise that option. Now let's talk about the settlement. If there is a gross settlement happening, then Mr. A will transfer the shares to Miss B and Mr. A will receive 110. As we discussed that the holder or the buyer of the call of the put option becomes the seller of the underlying. That's why Mr. A is receiving the payment of 110 and selling or transferring the shares of that company called as X Limited. And in next two cases, it will be nil nil, add the money out of the money, and the premium paid is rupees 10 that is paid on the inception date. On the net settlement basis, students, net settlement in the first case, 110 minus 95, so 15 rupees will be received by Mr. A and premium paid is 10 rupees. So the net gain slash loss is 5 minus 10 for next two cases students. And for Miss B, since she is an options writer, the premium computation is limited and the loss is minus 5 in the first case students. I hope things are clear students till now. Is there some other query till now? Please do let me know. Otherwise, we will move on to the next part. So students, if you really understand that how does an options works, what are the payoffs, who is the unlimited gainer, who is the unlimited, where is the unlimited loss happening, then you will be able to grasp it further. And hence, you can solve the questions easily. Now, holder for call option, better if spot price goes up beyond the strike price. That is a beneficial situation for the holder. So, this is the key outcome of the entire discussion on the payoffs and even other things. So, the holder of the call option who has purchased this call option, he or she will be better if the spot price goes up and beyond the strike price. For put option holder, now tell me students, what is better for a put option holder? Is it the prices going up or is it the prices going down when we compare it with the strike price? Yes, very nice. Abrikesh has responded. No, Viraj. Just see, the prices going up is beneficial for the call option, but the prices going down will be beneficial for the put option holder. Clear? As we just now discussed, the put option payoffs, in that the spot price goes down, the strike price, then only the put option holder will benefit. Now let's discuss about the options and futures as the differentiating factor. So options and futures, both of them have an underlying asset. They both have a time limit. As we said that futures were going to expire within 1 month, 2 months, 3 months, like that, and options also have a expiry. Now futures is a mandate, students, and options is a right. It's a right. And it is such a right that holder will only gain subject to premium. Here there will be a gain or a loss. It can be a big time loss. And we always see it and compare it in relation to the spot price. Where is the spot price moving? And here we see the future price. Since some benefit is being given to the holder, there is a premium being charged and there is no premium in the future. Clear? Yes. Now let's discuss the payoffs using this chart. So let's first take the call option, students, with buyer slash holder and having the long position or long call. The strike price is 40 and the premium is rupees 5. So we are talking about the payoffs, students, and the price of the shares. Now, the moment the price of the share increases, so we have plotted price of the shares on the x-axis and the payoffs on the y-axis. Now, the moment price of the share increases from 0 towards higher number, the the call option will become in the money option, right? Because higher the price, better it is. So till the time, let's say strike price was 40. So till the time strike price plus premium, the price comes, there will be no gain, no loss to the holder. And hence the payoff will be zero. Then it will increase. And it will increase to infinity. That is why we call the loss is unlimited to writer, and gain is also unlimited to the holder in this case. Now let's talk it from the perspective of a call seller, the person who is short selling the call option or who is the writer of the call option, students. Strike price 40, premium 5. So this person will start with the positive rupees 5 as premium received till the time prices moves to 45 and more. That person will gain. But the moment the prices increases beyond 45, there will be an unlimited loss that the person will be sitting with. So the gain is limited and the loss is unlimited. This is for the call seller. Here the loss was limited and gain is unlimited. Loss was limited to rupees 5, right? It will not go beyond that rupees 5, students. Now let's come to the right to sell, which is put option, and we're talking about the holder perspective. Strike price 40, premium is rupees 5. So as we know, students, if the price decreases, then only put option will be favorable or it will be at the money that we have discussed above, right? So the moment prices are getting reduced, the gain is increasing to the holder because it is becoming in the money. So here also loss is limited and the gain is unlimited. Loss is limited to rupees again 5, which has been given as the premium. Okay, so there is a benefit to the put buyer in case the prices goes below 35. Okay, students. I hope this is clear. Then the fourth part of the payoff is actually for the put option seller or the one who has done the short put. So let's say the strike price is 40, the premium is 5. So loss will be higher in case the prices goes down and below 35. So if you see 5 rupees gain is enjoyed by the option writer till the time prices moves below 35, then loss will become unlimited. But the gain is limited, students here. I hope the payoffs are clear, students. Easy and simple till now. Perfect. Let's come to one more concept. So some of you might be thinking that how does a trade of future or options happens on a stock exchange? So let's understand through this three concepts. So let's say there is an equity market. Okay, first let's understand from the equity market, this one. There is a buyer and there is a seller. So buyer will buy at the spot price and seller will sell at the spot price. This is a general phenomena that happens in an equity market. In the futures market, the buyer will buy at the futures price. What was the futures price? The A is equal to P e raised to the power RT, right? This is my spot price and this is my future price. So P is the spot price. This is the future price. Okay. On the future price, that deal will happen. Now in options, can anyone tell me how are they quoted on a stock exchange? What is the price of an option or what is the value of an option? Can anyone tell me? How do you arrive at the value or the price of the option, students? Not arrive, but in a stock exchange, what is the value? Okay, so let me say this is actually the premium. So the premium becomes the price of that option, students. So buyer will buy at the premium and seller will sell at that premium. Similarly, this premium is bound to change, right? Because it is calculated basis the spot price, which is a moving price element, and it will keep on changing. That is why it is called as a derivative, students. Now let's come to the valuation technique, students. Again, an important one. So let's start with the concept. Now we are talking about valuation of options. Okay, let me quickly recap, students. So Viraj is asking when to buy call option, if the stock price is increasing or decreasing. So the call option can be bought if there is an anticipation that the prices are going to increase. Okay. Then only you will be gaining in the call option. Now, in terms of the valuation technique, now I was actually about to recap the entire discussion till now. So students, we started our discussion with the derivatives. What is the basic concepts of derivatives? What are the common features of derivatives? Then we discussed about the forwards and futures as types of derivatives. Both of them are mostly similar. However, the only difference is that one of them is a standard contract and another one is the over the counter contract or a customized one. The valuation is also very easy and simple. It's just a future value of the present value by multiplying in a discrete form or in a continuous form. That is also okay. Then we discussed about the uses of them for hedging purpose or for speculation purpose, right? Then we discussed about the background of options. We introduced this term called options. We discussed about the clear distinctions about the options from the forwards and futures. What are they? The biggest one is that the option gives you a right. It's not an obligation or it's not a mandate. However, futures and forwards are a mandate. Okay. Now, let's come to discuss the valuation techniques for an option. I think before that, I would request the technical team to please open the session for the students also to ask verbal and interactive questions, right? Because we are entering towards the last 30 minutes of the session. That is why. Ashok ji, hello. Okay, I think if anyone has any question, Abrikesh or Viraj, you guys can unmute and speak. or raise your hand. Okay. Accordingly, we will answer. Perfect. Now, on the valuation technique, students, on the valuation techniques, the first one is binomial model. What is really meant by binomial model? So, as the name suggests, students, bi means two, and model is wherein some of the calculation is involved. Now, binomial model two means one is the upper amount, second one is the lower amount. So, so this model assumes that always there is a possibility of two outcomes. One is the upper one and second one is the lower one. So the call option, let's take an example of a call option for the time to expire 3 months, strike price as 28, right? And 10 percentage is for per annum. If we have to take it for 3 months, it comes out to be 2.5% students here. We're talking about here. So let's say today is 0th day and we are sitting at 30. After 3 months, it is also given to us that if the prices move up, it will move up to 10%. If the prices move down, it might move down to minus 10%. Okay. So in case the prices moves up by 10%, it will become 30 plus 10%, which is 33. Okay. And if the prices moves down, it will be 30 minus 3, which is 27 students. Now, what is our strike price? And we're talking about the call option here, students. The strike price is 28. The price has moved to 33. That means there is a gain of rupees 5. Clear? 33 minus 28. Because we are talking about a call option, and in call option, the price increases, it will lead to gain. However, in the second case, because as I said that binomial model has two outcomes, one or two. The second one is lower now. For lower one, 28 is the strike price and 27 is the spot price. So come on, students, tell me whether this option is out of the money, at the money, or in the money. In this case, in the case it comes down to 27, it will become at the money, out of the money, or in the money, students. This being a call option. Viraj has responded, yes. Yes, it will become out of the money because the prices has moved down. It's not an option. It's not a right anymore for the holder, right? They can go and purchase it from the outside market. So the payoff will become 0 here. However, here the payoff is 5. Now, students, we have, as we discussed in binomial model, we have two different options, and under two different scenarios, and under both the scenarios, we understand what are the different payoffs. But we need to also understand that what is the probability of achieving a higher or a lower value. Correct? Now that probability calculation can happen through these ways. One is the probability of price going up. So U is up is equal to 1 plus R, which is the discounting factor minus D divided by U minus D. Or if it is a continuous compounding case, then we always use the formula e raised to the power RT. First of all, this is clear. Now, what is D and U? So okay, R is the rate of interest, regular one. Okay. Now D is actually the proportion of the reduced price. And U is actually the proportion of the increased price. Students, I am again um, telling this that now I think the session has been opened for all of you to ask. In case anything is there, please unmute yourself and ask. Okay. Perfect. So D is equal to the proportion of the reduced, which is 27 by 30, 10%. And proportion of increase, sorry, this is 0.90 and this will be 1.1. Correct? Now the probability is 1 plus 2.5%. Why we have taken 2.5%? Because 10% for 12 months and hence for 3 months it will be 2.5% students. Okay. So the probability becomes 62.5 basis this calculation. So the probability of price moving to 33 becomes 62.5. And the probability that the price will go down becomes 37.5. Simple. Now we have the probabilities. Sorry. We have the payoffs and we have the probabilities. Do we need to multiply the payoffs with probability? Yes, to arrive at the weighted average number. So this becomes 3.125, right? So 5 rupees become this much and this is already 0. So 3.125 is the correct pricing of that. But this is realizable after 3 months, students, right? This is the time period that we took. Sorry. So this is the 3 months, right? Now, the premium has to be calculated as on today, right? So we take a present value of this. Simple. Okay. Now let's move to the second method, which is the risk neutral method, students. Now here also we try to calculate the probability of the prices going up or down, right? And again with the two different scenarios. So let the probability of the price to be 33 be P. Accordingly, we can say the probability of the price to be 27 be 1 minus P, correct? Simple and easy. Now if the 30 rupees is the price as on today, the price of the equity share. So the probability will be multiplied in the future prices. 27, this is the probability. 33, this is the probability. And divided by the discounting factor, which is 1 plus R%. So what is happening? This is actual and this is the present value of the expected price. Correct? This is the present value of expected price. If we solve this, the probability again comes to be very much similar. Clear, students? So the value of option becomes the present value of the probability adjusted payoffs. The value of option means here the price of the option, or let's say the premium of the option, right? So the premium of the option will become the present value of probability adjusted payoffs. So the probability adjusted payoff was how much? 3.125. Yes. Divided by the present value factor of 2.5% for 3 months. And hence the value of the call option that will be quoted in the market will be 3.0487 students. Simple. So just to recap, we have discussed about the options, the detailed concepts, payoffs, the different parties, the context to those different parties who will become what at the time of settlement, the favorability and unfavorability in the money, at the money, out of the money, all those things. And now we have completed the two different methods of calculating the value of an option, which is the premium of an option, which are those two binomial and risk neutral method. Okay. Okay, now let's do this question. Question number 3. So this will help us in brushing up the concept of binomial method. A call option on gold. Now, students, you all should relate it. Gold is what? Gold is a commodity. The underlying is gold, so which is fine. And it is a call option. Call option is a right to buy. With exercise price of 26,000 per 10 gram and 3 months to expire, time is equal to 3 months. Strike price is given as 26,000 per 10 grams. So strike price is also called as exercise price. We use this vice versa. To expire is being traded at a premium of 1010 per 10 gram. It is expected that in 3 months' time, the spot price might change to 27,300, that is a higher one, or 24,700 per 10 gram. So it can move to higher or lower. At present, this option is at the money, and the rate of interest with simple compounding is 12% per annum. Is the current premium for the option justified? Evaluate the options and comments. First of all, students, we have to calculate the premium, because for justifying the premium, we have to first think that what is the theoretical value of the premium. Now, for that, we will be using the approach of risk neutral method, right? Or let's say binomial method, because both the methods will lead to the same conclusion. So a tree can be formed, let's say the higher and the lower value. For using this, we have to calculate the probabilities. Let us assume that the probability of the price going up is actually PU, and hence this formula, right? Now, students, please understand 12% is for the year. Time is 3 months. So accordingly, the rates will get multiplied. 1 plus 12 into 3 by 12 minus D is what? The price going low, the proportion of the price going lower, and U is the proportion of the price going up. So accordingly, the probability of the price going up is 0.8 and the price going down is 0.20 if we solve this, right? Hence, the value of an option can be calculated as follows. Yes, Abrikesh, is there a question you have
Yes,
raised?
this the probability of rising prices. Sir, here we are taking only annual rate, no? I mean, not a continuous cost of, the rate. So 12% divided, multiplied by 3 by 12 is okay. But here we have not to convert it to the continuous compounding.
No, no, no. If the question is indicating towards the continuous compounding, then we have to do this. Otherwise, we can go ahead with the assumptions in the questions.
No, in earlier cases where, there was only constant compounding was given and we have converted to the...
Yes, number 6 you are saying, right? In
yeah,
that.
maybe. Yeah, 6 also.
Perfect. So that's a good question, Abrikesh. See, what has happened in the earlier question number 6 is that they have also given us the e raised to the power values and natural log as well, right? So that indicates somewhere we can use that, right? However, in this question, there is no specifics that is given on any of the e raised to the power something or the natural log or anything else.
Okay.
Hence, we have gone ahead with the simpler option.
Okay. Thank you, sir. Yeah.
Okay, Brikesh. Thank you. So we have used the simple compounding here. Then, yes, we were here. So the probability of price going up, strike price remains same in both the cases. We have entered two lines here, up and down. So the expected price is 27,300 and 24,700. Now, since this being a call option, the price going up will have a positive payoff of 1,300, right? Which is the difference between 27,300 minus 26,000. And here it will be 0. Correct? Because it's an option. Again, I'm saying it's an option. It will not lead to any of the outflow from the holder's end, even if the prices goes down. Then we will multiply it with the weights of the probabilities, and the expected value of the option becomes 1040. But students, please understand this is 1040 as on the third month's end date. We have to take the present value as well. So value of the call option as on today becomes 1040 divided by 1.03, which is this much.
Sir, 1.03, how, it's 1 divided by 1.12?
12% into 3 by 12.
Okay.
The same rate, right? Okay. So it becomes 1009 point something. This becomes our yes. So this becomes our answer actually. So this is the value of the call option as on today. And since the question is also saying that it is getting traded at the money. At present, this option is at the money, right? And hence this option premium is justified as of now. Sorry. Okay. Then okay, let's see this. This is also a good question. Question number 6, to brush up our concepts on the options. The market received rumor that ABC Corporation's tie-up with a multinational company. This has induced the market price to move up. Definitely, it will move up because it will mean good business prospects, right? If the rumor is false, the ABC Corporation stock price will probably fall dramatically. That is also true. To protect from this, an investor has bought the call option and the put option. Okay. What are the details? He purchased one 3 months call with a striking price of 42 for rupees 2 for rupees 2 premium, and paid rupee 1 per share premium for a 3 months put with a strike price of 40. Okay. Now determine the investor's position if the tie-up offer bids the price of ABC Corporation stocks up to 43 in 3 months. So now they're saying that the actual price has been as 43. So now determine the investor's position. So what we understood, investor has taken a call option and a put option, right? Call option with a strike price of 42, put option with a strike price of 40. And 2 is the premium and 1 is the premium. 2 and 1 respectively is the premium. Okay. And the actual price turns out to be 43. So first of all, let's evaluate okay. First of all, we need to calculate that what is our total cost of entering into these two options, which is the 2 rupees for call option premium and 1 rupees for put. This is the total premium that has been paid. Okay. Then price increases to 43 per share, then call option, will it be beneficial, students? The answer is yes. Because the strike price is 42, the price has increased to 43. So there is a call option benefit that will come. Minus the cost of call and put, which is 3 rupees that we have declared above. So hence there is a net loss of 2. Still, there is a net loss of 2. However, because of this 43, the price moving up, the person has been able to make a gain of rupees 1. Now, determine the investor's ending position. Sorry, in the first part, I missed to mention one thing. What will happen to the put option, students? In the first part, what will happen to the put option? The put option strike price is 40. Already the market is quoting a price of 43. So it will become out of the money, students, right? Now, second part, determine the investor ending position if the tie-up program fails and the price of the stocks falls to 36. In this case, put option will be exercisable? Yes, because the market price is 36. I have a right to sell at 40. Will I execute that right to sell? Yes. And it will be favorable to me by the 4 rupees. And the cost is -3. So I will enjoy +1. I hope this was a very basic question, but it's clear, right? Understood? So students, is there any specific question you want me to do till now on the topics that we have covered till now, which is uh, forwards, futures, and the starting part of options? So in options, we are left with uh, only the Black-Scholes model, right? And even the put call parity theory. So these two things are left, right? That I want to start, let's say, because we will need some time to cover it up. But is there some other question you want me to do, or let's do this question number 8 then, till then? Okay. Yes. So question number 8. Sumana wanted to buy shares of EIL, which has a range of 411 to 592 a month later. Okay. So it has given us the range. The present price per share is 421. Her broker informs her that the price of this share can soar up to 522 within a month. It can go up or so, so that she should buy 1 month call of EIL. Correct? The prices are expected to go up, and hence the expectation is that to buy a call of that EIL. In order to be prudent in buying the call, the share price should be more than or at least 522, the assurance of which could not be given by her broker. Okay. So this is a problem statement. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price of 592 so that buying 1 month call of EIL at the execution price of 522 is justified. Advisor, take the risk-free rate to be this much and e raised to the power something. Now, Brikesh, if you see in this question, they themselves have given us the e raised to the power something, and hence we
Yes.
will take the similar rate to take the
Got it.
continuous
Got
compounding.
it. Yeah.
Now, higher rate is 592, lower range is 411. The spot price currently is 421. Can we calculate the probability using the risk neutral method? I mean, using the binomial method, right? So the probability that the price will go up, and please make a note, don't get confused within 522 or 592. The question is very clear. The question is asking us to calculate the probability of 592, students. Okay. So the probability of 592 is, we will take the continuous compounding factor of 3.6% minus the range that it might go up and the range that it might go down. That will be again compared with 421, students. Clear, students? So the factor here becomes 1.037 minus 0.976. So the probability that the price will go up is 14.18%. Yes, Abrikesh?
Sir, here earlier also, I mean, value has been given of E raised to 0.06. Now, my question is, in exam, are we show the working of how we have arrived at E raised to power of 0.06, or
No.
straight away we can take the because the value has been given?
No, not needed. I think see Ashish sir is also there. He can also throw some light on this question. Yes, sir.
Abrikesh, your question, I could not get you exactly what you want to ask.
Yeah, sir. In the question itself, the value of E raised to 0.036 has been given as a value. What is the value of this? Now, my question is, when the rate is a simple compounding, and we have to convert it into continuous compounding. So, I mean, straight away we can put this E raised to 0.036, or we are supposed to give how we have arrived at E raised to 0.036 in exam.
No, see, simple logic, Abrikesh. Whenever if value has been given in the examination, then you have to apply the same. Okay. Suppose if the value has been given E raised to power 0.030 and E raised to power 0.040, then of course you have to make the use the interpolation logic and then get the value of 0.036. Okay. That is a one part. Now, suppose if no value E has been given to you in the examination, then use simple compounding only. There will be no deduction of the mass. You know to do, there are some methods like doing the on a calculator or computing the value. Don't indulge yourself in this, because if nothing has been mentioned, you use a simple compounding. Okay.
No, that's fine, sir. But what my question is, this E raised to 0.036, are we supposed to show as a working? Sir, Divas sir, can you just go to question?
Just reverse it.
Sir, here in the last value, E raised to 0.036 has been given.
Yeah.
Okay. So my question is, how we have arrived at E raised to 0.036 should be given, or we can straight away.
No. See, beta, it has been, that's why I am saying, na, because this value is normally derived from the Excel table or by the use of E exponential table manually. Excel table, Excel means computer use, or E exponential table that has been provided. But however, since it is presumed that generally the table may not be provided in the examination, generally these values are appended with the questions.
Okay.
So you know to go to to solve how we have right. Why you show that it will be right? It is understood. Because whenever we are using the concept of derivative, it is always implied we are using continuous compounding. And if it has not been given in the question, so of course we shall use simple compounding only. So you not to worry about the same.
Okay. Thank you, sir. Thank you, sir.
Yeah. Thank you, sir. Then we arrived at the probability of price moving to 592 is at 14.18%. And the probability that the price go down is actually higher, which is 85.82%. So I think that is what was needed from the question, because it has asked us to calculate the probability only, right? So I think with this, today students, just to...
What is the conclusion in this case? Suppose it is not asked here, but suppose asked, then should we tell that it is not advisable?
No, then some other facts needs to be given in the question, Abrikesh, or some other calculation needs to be done.
Okay.
Right? See, they are just asking us to state as a matter of fact that, what is the probability.
No, but sir, here it is asked, no, advise her. Matlab, what should we tell her?
See, basically the probability, so we can mention that, the probability is lower to achieve the 592 price.
So you should not go for that.
Then we should not go for the broker's advice, basically.
Okay. Yeah, broker's advice. Yes, sir.
Yeah.
Thank you.
It is mentioned as advisor. Yes, you are right, Abrikesh. Okay. So yes, students, then I think with today we complete till options pricing on binomial and risk neutral method. Now, couple of things are left from the practical aspects that we will cover in the next session, which is the Black-Scholes model and the put call parity theory and some other concepts. So yes, thank you for the listening. I hand it over to C. Ashish sir now for his
Thank
concluding.
you. Thank you, Divas sir.
Thank you, sir.
Student, in today's session, of course, Divas sir has taken a very covered you can say about major portion of the topic of derivative has been covered in today's discussion. Now, of course, he has also started with some questions. Now, in addition to that Divas sir has discussed, that will be covered in the next class. One another topic, very important topic, real options. Okay, will be taken also cover the conceptual understanding will be also covered in the next class. So, and in the very beginning, I forgot to make a disclaimer, but I am now making a disclaimer. Now, student, please see these classes are derivative are meant for academic purpose only. Okay, of course, you were asking some questions like what are the practical aspects, etc. Little bit practical, maybe different from the theoretical. Of course, why? Because every country or every market has their own conventions and practices. So practicality can be different. For example, I just give you a very small example. One market may be charging any commission on a futures, other market may not be charging. So practicality can be different practical operations can be different, but the basic is the very same for the everything. And our purpose here to make you aware about the derivative is the to how we can use the derivative for hedging purpose, because hedging is one of the major exercise nowadays. Now, for because from company's point of view, speculation may not be that much objective of a company, but rather hedging is a very important aspect. However, what happens for hedging? General hedging is carried out for the say foreign exchange risk manage, foreign exchange interest rate. Okay, like we discuss weather derivative, electricity derivative. So all these are underlying. So underlying can be anything. Okay, but however, the basic understanding to develop the hedging for underlying, basically we use the stocks or stock index futures. Basically, these are used as a underlying, and then we make you understand the concept. Then we apply for the other. Of course, the purpose of this chapter only to how we value the forward, value the futures, and value the options. So I thought I'm sure that you must have understood what exactly the nitty-gritties of the derivatives from this topic. Now the same will be applied in our forthcoming topics like foreign exchange exposure risk management and interest rate risk management. So with this, we come to the end of the session. We shall continue discussion for the same topic in the next class. Deva sir, thanks a lot for sparing your precious time and enlightening the student on this derivative topic. And students, we also thank you for
Thank you, sir.
your patience listening, and we shall continue our discussion in the next class. Thank you. Have a nice day.
Thank you, sir. Thank you.
Thank you, Divas sir. Thank you, Ashok ji.
Thank you.
Thank you. Thank you. Thank you, Ashok ji.